In the 1980s, Japan looked like the future. Its companies were buying some of the most famous buildings in America. Its cars were taking over the world. Its technology was years ahead of its competitors, and its economy was growing at a pace that made the rest of the developed world nervous. At one point, Japanese companies were so valuable that Japan accounted for nearly half of the world's stock market value. The country had gone from the ruins of World War II to becoming one of the most powerful economies on Earth. People began asking a terrifying question: would Japan eventually overtake America? But then, something changed. The stock market crashed. Property prices collapsed. Banks were left holding enormous amounts of bad debt. And an economy that had seemed unstoppable suddenly stopped. What followed wasn't a normal recession. It lasted for years, then decades. Japan entered an economic period so unusual that economists would eventually give it a name: the Lost Decades. But the strangest part is that Japan never became a poor country. It remained wealthy. It remained technologically advanced. Its companies remained globally important. Yet the incredible growth that had made Japan the future never came back in the same way. So how did one of the greatest economic miracles in modern history turn into decades of stagnation? Was the bubble the real problem? Or was something much deeper already broken underneath Japan's success? Because Japan's story isn't simply about a crash. It's about what happens when an economy becomes so successful that it starts believing the good times can never end. And the decisions Japan made at the height of its success would shape its economy for the next 30 years. This is the story of how Japan became the future, and then everything changed. The turning point came in 1985. Japan was already an economic powerhouse. But its success had created a new problem. America was buying Japanese cars. Japanese electronics were everywhere. And Japan was running enormous trade surpluses. The pressure from the United States was growing. So in September 1985, the world's major economies met at New York's Plaza Hotel. They wanted to weaken the American dollar and strengthen currencies like the Japanese yen. And it worked. The yen surged. Japanese exports suddenly became more expensive. For an economy built around selling products to the world, that was dangerous. Japan needed another engine for growth. So policymakers turned inward. Interest rates were pushed lower. Credit became easier. And banks began lending enormous amounts of money. At first, it looked like the perfect solution. Japanese businesses expanded. Consumers spent. The economy accelerated. But then, the money started flowing somewhere else. Into stocks, into land, into property. And suddenly, everyone wanted to get richer from assets that were already rising. The Nikkei had been around 10,000 in 1985. By the end of 1989, it had reached almost 39,000. Land prices were exploding too. In Tokyo, property became so valuable that the land beneath the imperial palace was famously compared to entire countries. The numbers were becoming absurd. But nobody wanted to be the person who said the boom was over. Because when everyone is getting richer, it becomes very difficult to believe that the wealth might not be real. Banks believed property prices would keep rising. Companies believed cheap credit would continue. Investors believed the market could only go higher. And the government believed the economy had entered a new era. But underneath the optimism, something dangerous was happening. Debt was growing. Asset prices were becoming detached from reality. and the entire financial system was beginning to depend on prices that could never keep rising forever. Then, in 1989, the Bank of Japan finally began raising interest rates. The party was over. And when the bubble finally burst, Japan didn't just lose money. It lost something much more difficult to recover: confidence. Businesses stopped investing. Banks were trapped with enormous amounts of bad debt. Consumers became cautious. And an economy that had once seemed unstoppable entered a period of stagnation that would last for decades. But the crash itself was only the beginning. Because Japan's biggest problem wasn't that its bubble had burst. It was what happened after the bubble burst. But Japan didn't simply recover from the crash. The damage had changed the entire economy. Companies that had borrowed heavily suddenly found themselves buried under debt. Banks were holding billions in loans, backed by assets that were no longer worth what they had been. So businesses stopped borrowing. They stopped expanding. They started paying down debt. And households did something similar. They became cautious. They saved. They delayed spending. And when millions of people and businesses do that at the same time, the economy loses something incredibly important: demand. Prices began falling. And falling prices created an unusual problem. If you expect something to be cheaper tomorrow, why buy it today? That meant weaker spending, which meant weaker business investment, which meant weaker wages, which meant even less spending. Japan had fallen into a cycle that was incredibly difficult to escape. And then, another problem began becoming impossible to ignore. Japan was getting older. The working-age population began shrinking. The number of retirees kept increasing. There were fewer workers supporting more people. And the government responded the way governments often do when growth refuses to return. It spent infrastructure, stimulus packages, social spending, more borrowing. Japan accumulated enormous amounts of government debt, while growth remained weak. But here's where Japan's story becomes much more interesting. Because despite everything, Japan didn't collapse. It remained one of the world's richest countries. Its companies remained global leaders. Its people remained highly educated. Its infrastructure remained world-class. Japan had survived, but it had lost something: momentum. For decades, the country had been trying to escape the consequences of a bubble that lasted only a few years. And now, in 2026, Japan is entering another turning point. Deflation has largely disappeared. Inflation has returned. Wages are finally rising. And interest rates are moving higher after decades near zero. But that creates a new problem. Japan has accumulated a mountain of debt, more than twice the size of its annual economic output. And as interest rates rise, the cost of carrying that debt rises with them. Japan's 10-year government bond yield has recently approached 3%, levels not seen since the 1990s. So the country that once showed the world how to survive a debt and deflation crisis is now facing a completely different question. Can it escape the past without creating a new crisis? Japan's story isn't really about one bubble. It's about what happens when success creates excess, when a crash creates fear, and when fear changes the behavior of an entire generation. The Japanese miracle didn't disappear overnight. It slowly changed into something else. A wealthy country that stopped growing the way it once had. A technological powerhouse that struggled to create the same momentum. And a financial system still dealing with decisions made more than 30 years ago. Japan was once seen as the country that would inherit the future. Instead, it became a warning about what can happen when an economic boom becomes impossible to sustain. But perhaps the most important lesson isn't that Japan's bubble burst. It's that the consequences lasted far longer than the bubble itself. The boom lasted a few years. The damage lasted decades. And today, Japan is trying to prove that it can finally move beyond them. Whether it succeeds may tell us something much bigger about what happens when a modern economy reaches the limits of debt, demographics, and growth. Because Japan wasn't the first country to believe that its economic success could last forever. And it probably won't be the last.